All right. Well, welcome everyone. Thank you for joining us today for our Lear May 2025 Market and Strategy Update. My name is Tom Steinley, Director of Business Development at Lear. I'm joined by our co-host, Jim Warner, who is Head of Research and Co-Portfolio Manager at Lear. If you haven't already done so, I would encourage you to read Jim's most recent market newsletters, both distributed in April. For your benefit, we copied and pasted the PWA link in the chat box. So when you get a minute, open the chat box, copy that, and then make sure that you have that handy. This Progressive web app is where we store all of our content, both written and recorded. So it should be real handy for you. In Jim's last pieces, he tried to make some sense out of the recent market noise, which obviously there's a lot of, and it's causing uncertainty. And as we all know, markets do not like uncertainty. But uncertainty also creates opportunities. And frankly, this is where our firm shines. We rely on our own research to make portfolio management decisions. We adjust portfolio allocations based on what's going on in the world. And most importantly, we communicate how external factors affect the portfolio changes that we are making. And that's frankly what the webinar is, this webinar is all about. So before I turn it over to Jim, just a couple of reminders. We encourage you to ask questions. Please do so through the Q&A box at the bottom of your screen. I also want to remind you that I will be following up and sending each of you the compliance approved replay of the webinar along with Jim's approved slide deck. So with that, Jim, let's jump right in.
Great. Thanks, Tom. Thanks, everybody, for being here. Let me share my screen here so we can get into this. We've got a lot to talk about today. There's a lot going on, of course. And, as Tom mentioned, I'd love to get your questions too. So, all right, so to jump right in, the topic of this month is the de-escalation, certainly around the trade tariffs, has created a market lift. And so the appropriate question now is, now what? If we take a quick look at what the S&P has done, basically the S&P is now sitting around 3.5%. It is down 3.5% this year. Staged a big recovery after the April 2nd Liberation Day, which some people jokingly refer to as Liquidation Day. And obviously what happened during that announcement, which really took the market by surprise, was that these reciprocal tariffs were way higher than anybody expected. And so, of course, fears went immediately to a fairly severe global economic recession, and asset prices dropped precipitously. Now that we've had a pretty remarkable recovery since then. On April 9th, of course, which the reciprocal tariffs were paused, and the market had its third best single day gain since World War II. So it stayed to be it definitely worked out if you stayed in the market. Volatility obviously spiked, and now it's sort of coming back down to more healthy levels. And where we sit here today, the S&P has essentially retraced all of its losses since Liberation Day, but still remains 8% below its high. So the market is still, in questioning as to just where we're headed in terms of trade-offs. And so we're going to talk a lot about that. So clearly what's happening and what's lifting the markets is this de-escalation from the global crippling reciprocal tariffs that were announced on April 2nd. And really, the de-escalation is the most reasonable direction. And so I think that's what the market has really been, starting to price in. There is obviously a 3-month pause now that is on that, which will expire on July 9th. And I think what we will see over the course of the next couple of months are bilateral trade deals being announced, which I think will further de-escalate these tariff fears. There's rumors that we're very close on a deal with India. Yesterday I heard we were very close with on a deal with the UK. There's been lots of negotiations with the South Koreans and the Japanese. And the reality is these bilateral trade deals, they don't get done in a couple days. These are extremely complicated. And they're trying to obviously reverse, a status quo that has been in place for decades. So, I think, but I do believe that we will see sort of an eventual, trade deals that will be done much lower than the reciprocal tariffs. And that's certainly what the market is expecting as well. And what essentially this de-escalation does is it puts a floor under the market by lessening the uncertainty. So then what then? Well, we need to get to a point where we can quantify the economic damage that the kind of pro forma tariffs will ultimately cause the economy and to individual companies. But what's interesting too, and we'll get into some of the data here in a minute, that a lot of the companies that are really impacted, they took Trump for his word. During the campaign, he referred to Trump's as tariffs as the most beautiful word in the dictionary. They took him at his word, and they started to ship inventories in Q1 ahead of the tariffs. And they're also using an interesting strategy today, which can help at least defer tariff payments by shipping in goods and sticking them in bonded warehouses. So when they're in the bonded warehouse, they haven't technically landed, so the tariff isn't due. But what this merely is doing for some companies is they're hoping that the ultimate tariffs that are put in place are lower than the current ones. So this is particularly a strategy being used with Chinese goods, given the very high 125 to 145% tariffs on their goods. So, but once all of these deals are done, we are still going to get some sort of a profit hit to certain companies, and there will be some sort of economic damage, at least in the short run. And then the magnitude of this damage, of course, will be determined by the outcome of these trade deals. But there will be some. I mean, there will be some permanent impact that will have to get factored into a lot of businesses. And, whether this is higher prices for their goods, whether it's lower quantities, shifting supply chains, eventually these companies will adjust, but it will take some time. One of the adjustments, obviously, that the administration is trying to drive is reshoring or onshoring of manufacturing in this country. And the tax cut bill that is under works in Congress right now is loaded with tax incentives to encourage that. So when we step back and we look at kind of this, sort of flux that we're in right now, the key questions really that we focus on is how high will unemployment get during this transition period? And then how much contagion will there be into the services sector? So remember, this is all impacting the goods part of the economy, and the services sector is much larger. And that impact will be much more indirect, but it still could have an impact. And so the longer the uncertainty is there, the more damage there will be. And so, this is all kind of, a kind of wait and see issue. But, for now, the kind of worst scenarios have been taken off the table, and that's why you've seen the market climb this wall of worry. So also this month, we started another earnings season, and the interesting one of the things that we focused on was the Mag 7, because obviously the Mag 7 has been a big underperformer this year, and excluding Tesla, which had some unique production-related issues while they were changing over the Model Y. The rest of the Mag 7 all beat earnings and revenues this quarter, which is great. And frankly, more importantly, was that they didn't cut any of their CapEx guidance. Now, their CapEx guidance, as you all know, has been basically funneled towards building out these giant AI data centers and their large language models. And so we didn't see any cuts which were feared. In fact, Meta actually increased their CapEx guidance because they see opportunities to accelerate the build out of their AI plans. So the AI theme, we think, is still very much alive and very well. And we've even heard comments on the earnings calls from Microsoft and Meta that they're having a hard time meeting demand for essentially their AI solutions. So we still think that the AI trade is really in its early innings, and we're going to come back to this. The Mag 7, though, is not alone. We looked at essentially the 332 of the S&P 500 companies that had reported, and 78% had beat earnings. So Q1 is obviously still very good. Obviously, that's pre-tariff. So, it's a little irrelevant. Um, and importantly, though, a lot of the guidance out of companies was actually generally better than feared. Now, some companies did have to pull guidance, like, travel and various consumer discretionary names and the automakers. Companies that are very directly impacted by tariffs. They have no way of knowing what the future holds, so they have pulled guidance entirely. But generally speaking, this earnings season has turned out to be, better than feared. Now, what that's created as we've gotten this very sharp recovery from the worst fears of the reciprocal tariffs, is an interesting rebound in valuations, but a deviation that is important to note. So this graph, I showed this graph last month, and it's updated for this month. The top line is the Magnificent Seven's PE, and the bottom line is the rest of the S&P 500's PE. And what's interesting right now is that the Mag 7 is still trading below their 5-year valuation, the 5-year PE. And so that indicates that there is some room to increase. And it would make sense too, because these are companies that are also a lot less impacted by tariffs and frankly, economic cyclicality. Conversely, the rest of the S&P 500 is now trading at a peak multiple, so above their 5-year average. And this is really pretty bizarre in some ways because these are businesses that are generally more subject to tariffs and more subject to economic downturns. So it makes us a little cautious on these names and going forward. What's really happening if you dig deeper into the earnings estimates for the Mag 7, which is the chart on the left, and the rest of the S&P, which is the chart on the right. I know this is a little difficult to see, but basically what we did was we looked at the changes in the 2025 earnings estimates and the 2026. So 2026 is the purple line, and the orange line is 2025. And what you can see for the Mag 7 is that there hasn't been a whole lot of change. Maybe just a little bit on the 2026, but frankly, not a lot of change on 2025. But if you look over at the rest of the S&P, again, that has more impact to tariffs, more impact to potential downturn in the economy, earnings estimates are really basically cratering. And so this is a concern. And this is kind of what we want to avoid, right? We want to avoid companies that are seeing their earnings estimates really get hit. So let's do a really quick economic check. One of the things you also might have heard about during the month was that Q1 GDP came in at negative 0.3%. Now, before you start worrying about recession and that sort of thing, it frankly is not a big deal. And one of the reasons for this is that there was this, I mentioned earlier, that a lot of businesses played this smart. They saw that the tariffs were going to happen at some point during the Trump administration, so they front-loaded their buying and they imported a whole bunch of their goods ahead of time. So what that actually created was a massive drag. So if you remember back to your macroeconomics 101 class, GDP is essentially is personal consumption plus fixed investment plus government spending plus changes in inventory minus imports. And what we had was this massive surge. In fact, you can see over here I disaggregated the components of GDP in this red bar over here on the right. There was a 122% surge in imports. Now, that's obviously not going to stick around. So that noise goes away next quarter. There was probably a little bit of an impact in the surge in change of inventories as well that won't reoccur. But basically, the positives that you can take away from this negative print is that that the personal consumption and fixed income remain pretty strong. So when you kind of back out all the noise, we're trending right now for Q2 to have about a 2% GDP growth. Now, again, a lot could change as, with these tariffs and what the actual outcome is there. But what I mentioned this just because I don't believe right now that we are in a recession. It doesn't appear that we are once you back out some of this noise. I mentioned that there was a lot of stocking. I just threw this chart here on the right just to show you that durable goods, this big surge in spending basically factored in as well. But more importantly, let's talk about payrolls, right? So payrolls came in actually better than expected last month. It came in at 177,000. The street was expecting a lot less than that. Unemployment claims too, which is more of a real-time view on what's going on in the labor market, really haven't spiked very much. This is, there's you. So in other words, we haven't been seeing companies, that are impacted by tariffs just lay off bunches of workers. That hasn't happened yet. Now, it does feel a little bit like we are kind of teetering on the edge of a number of companies laying off a lot of workers. But the reality is these CEOs have sort of held in there so far until they kind of know what the ultimate end result is of these tariffs. But the longer this goes, the more I fear that you'll see more layoffs. But where we sit here today, these are not recession type numbers. This is actually a pretty decent labor market. And so we just, but again, that all could change, and we'll have to wait and watch. We talked a little bit about last month about the impact that DOGE could have potentially on payrolls, and frankly, it hasn't been very much. According to the Bureau of Labor Statistics, only about 21,000 government employees have lost their jobs on a net basis. That's like less than 1% of the total government employees. There are more cuts on the way for sure, but I think at this point we can say that DOGE's bark may be bigger than its bite, at least as far as job terminations are concerned. The other really interesting component of payrolls is, what we've always referred to as the canary in the coal mine is temp workers. And the reason why we think that they're an interesting signal to watch is that temp workers are obviously the easiest to hire and the easiest to fire. So when things really go badly, you get rid of your temp workers pretty quickly. You can see what's basically been happening for the last 18 months or so, or 2 years, is temp jobs have actually been declining pretty steadily. They're down 20% from the peak during the post-COVID surge in payrolls. And there's this really kind of mysterious stabilization that's happened over the last 6 months. You can see the chart on the left just sort of is the detail from the longer term chart on the right. But it's a pretty flat number of jobs in temp jobs over the last 6 months, which again indicates that there's no real panic that is set in yet with employers. But let's just say we do see some sort of a payroll decline. And, I think it's fair then to ask, will the Fed come to the rescue? There's obviously been a lot of jarring, back and forth, rhetoric back and forth between Trump and Powell. I think you just ignore all of that and let's just look at the numbers. But the reality is, the Fed has two mandates, right? One is full employment. The other is keeping prices around inflation around 2%. And I think what you certainly can see here from this inflation data, that the Fed does have room to cut if they need to. If we do see a big fall off in payrolls, the core PCE in March was 2.6%. And if you stripped out housing, which is basically decline in a pretty steady state of decline, we're at 2.2%. So basically we're right around kind of the target levels that the Fed wants. So I think there's room for a cut if needed. I oftentimes show this slide, which is a real-time inflation gauge from a company called Trueflation. I love to look at this. They think that inflation is actually running closer to 1.37%. So, that's well below the 2% target. So I think that the Fed meets today. I think you're not going to get any cuts. I don't think you're going to see really much change in the messaging. But I think when you really kind of peel back the onion, you'll see that there is room for the Fed to cut if things really turn out poorly. Now, of course, the reason why they're not cutting today, partly because the payrolls have obviously come in pretty good, so the labor market's pretty healthy. But there's a concern that there could be inflation attached to the tariffs. And while that really hasn't hit yet, there is concern that it could in the future. And so, they're kind of keeping their options open. All right, so this is the most important part, really, is portfolio strategy. So, one of the things that makes us very different than most money managers is that we are tactical. And oftentimes when we tell people that we're tactical, and we tell them that, what that means is that we change the amount of risk in the portfolio depending on the market cycle. How do we do that? We do that by changing, asset allocation. We do that by changing the betas in the equity portfolio. There's a variety of different ways that we do that. And usually as we get into that discussion, eyes glaze over. So I thought this is another fun way to actually convey exactly how we invest. And it's called the OODA loop. And the OODA loop was a concept that was created by an Air Force pilot by the name of Colonel John Boyd. And he was a legendary dogfighter. And one of his big claims to fame was that no one could ever get him in a dogfight. He was always the winner. And he described his ability to do that by what he called the OODA loop. And what this is really actually a very good way to describe our investment process. And so real quickly, what it means is that the OODA is just obviously an acronym for observe. So that means gather data. So for us, that means observe the market trends, economic data, all the stuff that we talk about in this presentation, for example, company news, industry changes, that sort of thing. Then the next O is orient. So we want to then analyze this data, understand the context, the implications, etc. Then we want to decide. We want to choose an action. Now, this means, what do we do to the portfolios? Do we take more risk? Do we take less risk? These are things that we ask ourselves on a daily basis. Do we want to own a different holding? How is this one that we have? How is it doing? How did it do on its last earnings report, etc. And then act. That means for us trade. So that means either buying, selling, reallocating, rebalancing, that whole bit. And then importantly, loop back to observe. So this isn't just a go through this once in a while type exercise. This is a constant, ever flowing loop of essentially assessing what's going on in the market, making the appropriate changes to portfolios. So this, I think, is a really great description of our investment process, and I think something that makes us pretty unique in the way we manage money. So we've gotten this post-Liberation Day rebound. What now? There are, as I mentioned, still a lot of unknowns. We still don't know the economic impact of tariffs or what the impact is going to be on various corporate earnings. Next quarter is going to be very, very interesting to see how some of this tariff impact really flows through to companies. So for the near term, we are being very selective in the stocks that we own. And what do we mean by that? Well, we want stocks that have bulletproof demand for their goods or their services to sustain revenue growth. And we want predictable supply chains and cost structures. So you can already tell that this excludes a lot of names from what we're willing to invest in today. So you won't see trucking in our portfolio. You won't see automakers in our portfolio, right? With the one exception of Tesla, but that's a whole different ballgame. But you won't see Ford or GM. There's a lot of consumer discretionary names that don't fit the bill. So this is basically self-selects us down into very sort of high quality names with great fundamentals. And we've seen a lot of value in some very specific equities, and particularly also some commodity exposed names where stocks have been hit very hard. But because the global recession thesis is being taken off the table, they just haven't quite recovered just yet. So there's a lot of opportunity out there, honestly. So what we think is going to happen for really the next few months is that this next leg for the market may be pretty choppy and pretty narrow. So I think, the easy money's been made, right? Everybody freaked out. We took advantage of that. We bought stocks. And the de-escalation has obviously created this nice market recovery. But I think going forward, we're going to have to be very selective in what'll actually work. And one of the ways that we sort of think about this from a question standpoint is, what is our confidence level in a particular company's 2026 earnings? So for some companies out there, you can say with a fairly high degree of confidence, that it should be whatever, $5 a share. But for other companies out there, because of the uncertainties that exist in the current environment, you have no idea. And we want to avoid those. So the way I would basically, kind of summarize how we're thinking about investing right now is that we're in what I'll call sniper mode. we're being very patient and but we are willing to take specific bets. So from a portfolio strategy perspective, one of the things that we've been adding to is technology. And one of the reasons is that technology, and you can broadly include Mag 7 in that as well, is fairly under-owned by money managers after this big pullback that we've had. But many of these tech names fit our, selective criteria. They've got great demand for their services. They understand their cost structures and control them, have very little impact to cyclical issues or tariffs. So we actually think that there could be a bit of a bid for technology in the near term. This is causing us, though, to, obviously slowly and deliberately deploy our excess cash that we previously raised, and in a very sort of disciplined approach. And I think the commonality of across a lot of these names is that we're finding that companies with great fundamentals, with predictable earnings, but have just gotten beaten up on bad sentiment, those are really interesting opportunities. And so, we talked about a month ago about how we bought CACI, which is a defense IT services kind of software company, got beat up on Doge fears. That stock's up 35% from where we bought it. So lots of really interesting opportunities still exist in this market, irrespective of the kind of uncertainty that still hangs over the broader economy. We're avoiding stocks with material exposure to tariffs, obviously. Or said differently, we want to avoid business models that are in flux, right? It sort of defeats our whole demand for companies that have great fundamentals and predictable earnings. Our gold, MLPs, mortgage REITs, fixed income positions, they've all been great hedges, and we're actually starting to dabble in Bitcoin. I'd say the two themes we're sort of that are in their nascency that we're very interested in and we're developing is Bitcoin and robotics. And if you hadn't have a chance, the Tesla earnings call is really pretty interesting. Tesla, for example, will make something like 1 million robots for factory work by the end of next year. And if you just stop and think about that, a robot basically can work 7 days a week, 24 hours a day, and doesn't complain. And what's really pretty remarkable is some of these things are as cheap as $300 a month to lease, which is, incredibly cheap compared to typical labor. So there is a really interesting theme of like a manufacturing renaissance that could happen with robotics as they become used more and more in factory settings. So very interesting stuff, still early days on that. And then I think the other thing we'd mention is next up on the Trump agenda, again, things that could be positive as trade deals are worked out. There will be tax cut legislation and deregulation, and we haven't even begun to see or even try to factor into models for the economy or for individual businesses what those benefits could be. So, where we sit here today is essentially could be summarized as avoid the landmines and buy companies with strong fundamentals but poor sentiment. The next couple slides really just goes through our individual, sort of our 4 big strategies. So global vigilance, the conservative business. Frankly, we didn't make a whole lot of changes to it this past month, but it's been doing great. It's up on the year, 1.8%, gross of fees, and it's had a really nice run. This strategy has been around for a little over 10 years and has really done a great job for conservative investors. Our moderate kind of flagship strategy, global vigilance, is actually right now we're basically at the conservative end of where we typically run from an equity allocation standpoint. We're around low 50s. And we've kept our fixed income duration really short. Really haven't gone out on a limb there or taken a lot of credit risk either. And it's done quite well. It's basically flattish on the year. Again, with the S&P down 3.5%. We're pretty happy with that performance. And I think what we're probably most happy with is the fact that in the 10 years plus that we've been running this strategy, that it's returned 7.4% gross on an annualized basis. So we're very, very proud of where that has gone. The other really interesting thing I thought I'd show you today was just how tactical actually works, or UDA, just to use our new favorite word. And it's to look at the actual portfolio cash position in our global vigilance moderate strategy, and just to show you, just how we can change risk in the portfolio and how quickly we can do it. If this graph on the right basically shows the percentage of cash or very short-term treasuries that we hold in the model. And you can see that when things are really getting dicey this first quarter, we basically started increasing our cash position and got all the way up to 13-ish%. But more importantly, so it's very easy to sell, right? It's easy to sell when things start to get crazy. The hard part is putting money back to work, and I think that's where we're particularly good. You can see that we very quickly took this cash position down from 13% all the way down to basically 2, or 3-ish. And you can see that these spikes before, this was a big pullback back in 2024. But it's essentially what we do is we protect, and then we, are very good at sort of putting our foot back on the accelerator and taking risk at lower levels in the market. So this is another sort of, along with the UDA concept, this is really how tactical works to protect risk, protect portfolios. And then until this is our more aggressive, this portfolio has really had a great run. I mean, year to date, this is largely an equity strategy. It's got 71% equities, 16% commodities. It's up, almost 4.5% year to date. We're super excited with how this has performed. And honestly, this has just been really good stock picking. And then finally, and then we can take some questions. Our strategic income model, this really was designed for conservative investors that needed a little extra yield. And this is particularly important back when we had 0 interest rates, right? Now it's obviously a lot easier to get yield, but we wanted to be able to get yield without taking too much risk. And so this has actually been a really great performer as well, this year, as well as over the last, since we started it. So, Tom, maybe we should stop there and let's take some questions.
Yeah, great, Jim. Thank you. That was awesome as always, and I love the UDA reference. That's a term I'm going to start using. So while we're waiting for some of the questions to hit the Q&A box, let's talk just a little bit about the interest in Bitcoin. What theme does that play into of ours, and what purpose would it serve in our portfolios?
Right. So, for a long time, we have not been big fans of Bitcoin. And one of the key issues was that the regulatory environment could flip on it, and honestly make it worthless literally overnight. Now, that all changed when Trump got elected, and he is actually very pro Bitcoin, very pro cryptocurrency. And so that took a very large concern off the table. A lot of we've had obviously a lot of success with gold. And I think the popularity of gold is also relevant to Bitcoin. What people have started to worry more and more about is the sustainability, for example, of the US debt, and where, generally speaking, fiat currencies are headed. And so there has been kind of this very interesting attraction to gold that has really benefited a lot of our portfolios. And we think that same sort of attractiveness exists for Bitcoin. While it's not in all of our portfolios by any stretch, it's only in our most aggressive tilt strategy. We needed to have some exposure there because it really does have the opportunity to get rapid adoption. And you can just pull up any sort of video on YouTube for all the reasons why the Bitcoin bulls love it. But I think it's just it's a very important, in this world where we're kind of seeing fragmentation that's being driven by these tariffs. The alternative currency is starting to have more, I think, of a role. And so we want to at least have some exposure to it.
Right.
The other thing I would also mention is I think it actually could be a very interesting diversifier to the portfolio. I don't think it necessarily should behave in a correlated fashion. Like it shouldn't have any economic implication. It should be no like cyclical implications. So I think it's just another asset that you can have in a portfolio that diversifies it during, kind of chaotic times like we have today.
Great. Okay, here's a question. What will be the results of the trade tariff talks with countries like India, Japan? What do they need from us?
Yeah, it's a great question. I mean, the I'll tell you what I think there's going to be a very interesting deal with India. India is kind of like the new China of like a couple decades ago. As you all know, we've been big fans of India. We own an Indian bank in our portfolios, and we've had that for a long time. India can provide very, very cheap labor for very important things. For example, like rare earth processing, which right now is 100% done. Basically, 100% of it is done in China. So there are some very interesting national security implications that China can help solve for the US. So I would actually expect that whatever does come out of it will actually bring our two countries closer together. So I think that's going to be very interesting. Japan, again, there are various things that we make in this country that have no applicability, to Japan. I mean, you don't see people in Japan driving around in Ford F-150s. But do they need F-35s? Probably. Do they need Boeing airplanes? Probably. So I think there's going to be I don't know all the intricacies of the contact points that we have between our two countries, but the reality is that something along the lines will get done, and I think it will help set the stage for perhaps bringing some manufacturing back to the United States, and the ultimate impact of these tariffs and the ultimate impact of reshoring manufacturing. I don't think anybody has any idea, what that's going to look like, let alone 6 months from now, 2 years from now, 5 years from now. So we're all on this kind of roller coaster ride together from that perspective. But yeah, I mean, I think I'm just as interested as you as to what the details are, because once we start to get the details of a few of these trade deals, we'll actually start to it will have some predictive power, I think, in terms of assessing what future trade deals will look like, maybe even with, say, China.
Yep. Great. Okay. Here's another one. If you had a client that has cash to put to work now, what strategy would you recommend? And would you lump sum invest or dollar cost average over what period of time, given to the current volatility?
Yeah, so I mean, our strategies are pretty straightforward in terms of risk profile. So obviously, the question is, what is ultimately that investor's risk profile? So I mean, if they're aggressive, tilt. If they're moderate, our global vigilance moderate. If they're conservative, choose the conservative version or strategic income. So it's, that's really up to the that particular investor's risk profile. For our custom portfolio, so as most people know, we offer our strategies in models, but if you have clients that are over, $750,000 for your bigger clients, we can do custom strategies. And these custom strategies are essentially, allow us to do what's called our tactical implementation program. And what that effectively is it is a systematic way that we deploy excess cash. And we do this for a lot of investors, because, the reality is, when you get, nobody likes to invest all their money at the top of the market, right? There's always a fear that the market could decline. And for all I know, we could see a market pullback in the course of the next 30 days or 60 days. So this tactical implementation program is a really, I think, smart way to, let your clients sleep at night, knowing that if the market pulls back, we're going to, in a very disciplined fashion, deploy excess cash into, stocks and bonds. And some clients really like that. Some of them, they just want to go straight in and invest it all. So that's something that we can certainly talk about with you and that particular client.
Great. All right, let's take one more. It's coming up on 45 minutes, but we do have one more question here. Did all the market's concerns about DeepSeek affect earnings of the U.S. tech companies?
No, not yet. It definitely impacted sentiment. I think you look at what really caused the AI names, whether that's the NVIDIAs of the world or, the electrification names, the folks that are building the data centers like the Vertivs of the world. When that DeepSeek news came out, it really impacted sentiment. And that was the beginning of their big pullback. But practically speaking, it's really hard to say. I mean, you're hearing literally nothing out of whether it's Google or Meta or any of the guys that are putting together AI models. They're not deterred in one bit. In fact, if anything, they're increasing their spending and really going after it. We talked about DeepSeek a few months ago when it came out. And it's frankly, we haven't really heard a whole lot about it since, which is kind of interesting. But no, I mean, we have not seen really the impact. I mean, at the end of the day, what I think we're most focused on is not necessarily the chip guys, but how this AI is actually going to get used. And one of the positions that we have in our portfolios is ServiceNow. ServiceNow is a company that is finding really great ways to use AI to drive productivity for its clients. And so it's those types of applications of AI that I think are the most interesting. We have a number of positions in our portfolios that fall in that theme. But it's a good question. But the answer is so far you've seen no real impact whatsoever from DeepSeek.
Great. Good. Well, I think that wraps it up, Jim. Thank you. That was a really terrific 45 minutes, great information, and we want to thank everybody for tuning in. The next webinar will be early June, which will be after Memorial Day. So we at Lear wish everybody a great month, and we'll talk with you in early June. Thanks.
Thanks, everyone.